All right, good day, friends, and welcome to our channel, Accounting Education. Today, we shall be treating a topic that is familiar with some of us, which is IFRS 5. That's non-current asset held for sale and discontinued operations. Non-current asset held for sale and discontinued operation is actually a sub of IFRS 16, which is non-current asset. But in this IFRS 5 treats what's it called, the assets that entities have decided to hold for sale, and for example, and also if there is any other one that you need to, that any asset that will not be useful for the continuation of business, or of an entity. This is what this IFRS is talking about. But for today's class, we shall be talking about two sections of this. The first one is the sale of non-current asset. Sale of non-current asset shall be telling us about how it should be handled. And the next one we shall be talking about is the assets that are held for sale. Assets that are held for sale. Sale of non-current asset, that is, if a non-current asset has been sold, how do you treat it? Then assets that are held for sale, for example, that is, they've not been sold but they've been held for sale. Okay, how do you treat it as an accountant? So let's start straight away with sale of non-current asset. Now, under this, we shall be looking at two things, which is the general rules on derecognition, then assets that are held for sale. Now, this is it. General rules on derecognition. Remember what IFRS 16 said about derecognition of a non-current asset. It says that all the carrying amount, that if you have a carrying amount, you must do two things. You must recognize it under two conditions, which is number one is if the asset had been disposed. If the non-current asset had been disposed, you must derecognize it. Then, and if there is no future economic benefit that are expected to arise from its use or from its disposal, then as an accountant, every entity must do what? Must derecognize such a non-current asset. Let me take it again. You derecognize a non-current asset when, one, it has been disposed. On disposal of the asset, you derecognize it. Then, secondly, when there is no future economic benefit that is expected to arise from the use of such non-current asset, then it is expected that you do what? You dispose it. I hope you're following. Okay. Now, if a non-current asset is disposed of, the gain or loss. Now, how do you treat the gain or loss of at disposal of every non-current asset? How do you treat it? That's what we want to talk about now. The gain or loss, remember, must be treated in your profit or loss account. It must be treated in your profit or loss account within the period with which such disposal occurs. The gain or loss should not be included in sales revenue. Please note, it must not be included in sales revenue. For example, if you have a generator that you dispose of, and and actually, generator is not the business. Sales of generator is not the business that you are engaging in your ordinary course of business. Is not the sale of generator. Probably you are selling furnitures. You understand? So if you sell your generator, you dispose, let me use the word, if you dispose your generator, whatever profit you seem to get from the sale of that generator should not be added to your revenue, because revenue recognition must be what you earn, what came in, the inflow that came in during or from your ordinary course of business. So you must not have the profit, or neither should you less the loss from your sales revenue. It's the profit or loss on the disposal of non-current assets must be identified only under the profit or loss account. Must be recognized under the profit or loss account. Okay, let me give us a little breakdown on that. Okay, now if you make a loss, for example, the rule says that you must less it from what? You less it from your profit. You less the loss on the sale. You net it off from your profit. You understand it? And if you make a profit in the sale of non-current assets, where are we supposed to recognize it? We're supposed to recognize it under the OCI, that is under the other comprehensive income. That is where such a profit or a gain of this in the sale of non-current assets should be recognized. I hope we are following. Okay. All right. I would quickly show us an example now. I'll show us an example, just a brief illustration on how to recognize the gain or loss, or how to calculate the gain or loss on disposal of non-current asset. The first thing you will do, like you will see on your screen now, is that you would write out the sale proceeds on disposal. The sale proceeds on disposal. The sale proceeds on disposal. That is the amount that came in, the amount of inflow that came in as a result of disposing such a non-current asset. That is what you're going to write first. Then the next thing is you less the disposal cost. Now, lessing the disposal cost has some guiding rules. You must know that the disposal cost includes this, and there are some that it does not include. This disposal cost will always include the cost at which you advertise the sale of that non-current asset, the cost for let's say the professional fee that you pay to, for example, any professional that helped in the process of selling, or probably any professional that ascertain the condition of such a non-current asset. For example, you want to sell a house, you need a QS a QS or a valuer to value it. Such a cost is professional fee. You identify it, is part of the disposal cost. Now the cost of moving, if for any reason you want to move such a non-current asset from one location to the other, so that you can it can be easily accessible to the buyer, such a cost should be identified under the disposal cost, and so on and so forth. Every cost that is attributable to the sale of such a non-current asset should be identified under the disposal cost. Now, when you pull all this together, you will less it from the sales proceed, the amount that you sold the non-current asset. You understand? So that will now give you the net disposal value. What did I call it? I call it the net disposal value. Excuse me. So this is what you will get at that point. Now, assets at cost, revalued amount. Now, you would now identify how much is what is the amount, what is the cost of the asset. Or if you have engaged in any form of revaluation, you identify it, bring the value out, the cost of the asset or the revalued amount. For example, now let me clarify this. When I say the cost of the asset, that is the original cost, the amount you bought the cost, the historical cost of the asset, the amount you bought the cost, the amount you bought the asset when the asset emerges. into your company. You understand it? The very first cost that you spent on that asset is the historical cost. And or if the asset had been revalued, you know, you will take the revalued amount, identify it here under this column that you're seeing here now, and you will less the accumulated depreciation. Of course, you know you have to less the accumulated depreciation. That will give you the carrying amount. That is the formula anyway. Cost minus accumulated depreciation gives you what? The carrying amount. Carrying amount at the date of disposal. Okay? You will now less whatever you are getting. Now, if you are not given cost in your question and you are not given accumulated depreciation, please just go to your carrying amount, bring it under the net disposal value, take it away from the net disposal value. It will give you either a gain or a loss on disposal. I hope you are following. Okay, so this is how to identify or calculate gain or loss on disposal of an asset. Like I said, today we'll be dealing with just two legs under the sale of non-current asset. We have talked about the general rules on derecognition, and I said that IFRS 16 states that you can only derecognize a non-current asset when it has been disposed, number one, and secondly, when there is no more future economic value that will be coming from the use of such an asset. Okay, now I spoke to us about how to calculate gain and or loss on disposal of a non-current asset. Okay, we're now going to talk about assets that are held for sale. Assets that are held for sale. Now, sometimes a company might hold an asset for sale, and they will have to hold it till the end of the year. You will have to hold it till the end of the year with an intention of selling it. Okay, so how do you recognize such a thing, such an asset? The non-current asset or group. Now, this could be in group, or it could be just an asset. Now, what is the difference between an asset and the group? For example, if you want to sell a factory, a pure water factory, a pure water factory will contain the land upon which the factory is built, the machine, the building on it, the fixtures and fittings, and every other thing that is that forms the component of such a pure water factory, for example. That is a group of non-current assets. That is what we mean by group of non-current assets. That also can be held for sale. Now again, a branch of the company can be held for sale. A branch, like more or less like a whole entity, a sub-entity of the company can be held for sale. That is what we mean by a group of non-current assets that meet certain strict criteria are classified as being held. Now, there are criteria with which the holding for sale must meet before you can classify it. Now, this is important for us as accountants because you may get to probably you want to audit a firm, and or you are preparing an account for them, and then they are telling you that these assets were held for sale, and so it should be derecognized. This one, that cannot be acceptable until some certain criteria are met. We will discuss those criteria in our subsequent classes. Because for today, I just want to focus on these two sublegs on disposal, asset held for sale. Non-current sale of non-current asset. All right. So, subject to an impairment test, non-current assets that are held for sale are subject to an impairment test. You know what an impairment means? That is, if the asset had been, impaired, if it has reduced in its value, or we better say, that when the recoverable amount is less than the carrying amount, you say an asset has been impaired. When the recoverable amount is less than the carrying amount, you say an asset has been what? Impaired. So there is what is called impairment test. You is subject when a non-current assets that are held for sale are subject to one to impairment test. Number two, they are presented on a separate category on the face of the statement of financial position. They are presented on a separate category, on the statement of financial SFP. Then the next one is they are no longer depreciated. They are no longer what? Depreciated. They are no longer depreciated. So you don't depreciate assets that are held for sale. Then you must present it on a separate category on your SFP. Okay, and the very last one is that they are subject to impairment test. Why should we even subject them to impairment test? We have to subject them to impairment test because the sale value must be determined, must be checked. I we just showed us how to compute gain or loss. Before you can get an accurate amount or accurate figure for your gain or loss, you must be able to check if the carrying amount is actually more than the recoverable amount, or if the recoverable amount is more than the carrying amount. These are two things that needed to be checked. All right, I think at this point we should just stop, and I'm sure I will see us in our next class. Please like and share this video so that other persons can enjoy and we can have a bigger coverage on the social media. We appreciate you for your patience. We appreciate your attention. Once again, you're welcome to Accounting Education channel. Thank you so much. I'll see you in my next class.